Hey guys, it's James Dainard and I'm back on BiggerPockets, and today we are talking about bulletproof investing strategies for the remainder of 2022.
Only problem? I bought it from a fake seller.
James Dainard just walked over to my desk.
If you skip the first 3 steps, that's the easiest way to lose money.
So what we've seen over the past 22 to 24 months is kind of unheard of and is not normal. We've had low cost of money. The rate has been at zero. We've seen massive amounts of government infusions of capital. Almost 50% more dollars have been printed over the past 24 months than it has in the past 24 years. So what this has done is it's caused assets to hyper appreciate. And to be perfectly honest, it's made a lot of investors look better than we actually are. You know, you could really buy anything over the past 24 months and it was going to be worth a lot more. You could sell it, make your return, trade it out, or buy it right, get the right loan on it, and cash flow it correctly. Now, what we've seen is the government and the Fed are stepping in to make some changes. There's been a shortage of workers out there. There is over 11.5 million open jobs in the market. That is causing tons of different economic impacts. Cost of wages are skyrocketing. People aren't showing up to work. Things are not getting done. The low cost of rates has caused assets to just get overinflated. We have the stock market at an all-time high. Bitcoin went skyrocketing to its all-time high, and real estate has been appreciating at 10 to 20% a year, if not higher. I know in my local market, I've saw up to a 50% appreciation in certain neighborhoods. So what is the Fed doing to fix this situation? They are rapidly increasing rates. Over the past 60 days, we've seen the rates almost double in most sectors. If you're an owner-occupied buyer, you were getting rates about 2.75 to 3% about 90 days ago. Now they're at about 5 to 5.25. As an investor, we were getting money at about 4.25. And now what we're seeing is 6.5. So these sudden massive increases are going to slow the market down. And that's why it's so important to put the right plan in play when you're looking at that next deal. So there's certain steps you can take to make sure that your deal is bulletproof for any type of market condition change. So the first thing you want to do is pack your pro forma. What does that even mean? So any property that we are now buying, we are making sure that the walk-in margins are actually greater. Over the past 24 months, we've been looking at skinnier margin deals. So we may have been buying properties at 12 to 13% returns, not factoring leverage, but now we're looking at buying them at 15 to 17%. This extra padding in my pro forma is going to allow for any type of price adjustment or pullback from the cost of money being more expensive. Remember, cost of mortgage right now is 30% more than it was 90 days ago. That next buyer buying your next flip property is going to be paying a lot more even though the list price isn't going up. The second thing we're doing to make sure our analysis is bulletproof is we're looking at our comps. We're going with the cluster comps rather than the peak comp. Because the market was appreciating so rapidly, we were always using the peak comp in the market. We were still breaking down to make sure it had the same selling attributes, but we would go to the high. Now what we're doing is we're going to where the cluster is. That's telling us where more buyers are and where more activity is. When we're going with the disposition, we want to be right in the middle of the activity. The third thing we're doing is when we're looking at our BRRRR style properties is we're packing our pro forma with higher rates. When you're buying your BRRRR property, you have to buy it, renovate it, and then refi it into a new loan. That takes time. In a market where the Fed is saying that they're going to constantly increase rates, that gives you a lot of exposure as an investor. You want to mitigate this risk by factoring for this down the line. So for example, if I'm looking at a property right now, and I have to do a BRRRR on it to where I have to renovate it for the next 3 months, my current rate would be 6.5% when I go to do my refinance. In 3 months, the Fed could do additional rate increases, and so in my pro forma, I'm actually going to run my refi calc at a 7% rate rather than the current rate. You want to make sure you're factoring for any type of conditions that are coming forward. The Fed is not lying to us. They told us they are going to be doing an additional 3 to 4 more hikes through the remainder of the year. So to buy on the now rate doesn't make a whole lot of sense. Fifth thing we're doing is targeting different types of deals. For the last 24 months, we've been going after the higher profit, little bit more expensive properties. A lot of times we're paying about $800,000 for a property. We're putting about $200,000 to $250,000 into the renovation and then selling it for about 1.5 to 1.6. In addition to, we're getting a lot of bumps on the appreciation. But in a transitionary market, that can be a lot higher risk investment. If we purchase that next property for $800 and put the renovation cost in, we're into that deal for over $1 million. In our current market in the Pacific Northwest, our rents are only going to be about 2/3 of what the actual debt cost would be. That makes this deal higher risk. We only have one exit strategy for this type of flip. So as we go into a transitional market where things are starting to adjust and things are getting more expensive, we want to look at deals that we can do in any different types of ways. Similar to a BRRRR property. We are targeting low acquisition properties where the total cost, which is purchase price and rehab, is at 75% of the new fixed up value. That gives us a 25% buffer for any type of market condition change or affordability factor change. So let's go out and look at a bulletproof flip that we're doing right now. We bought it right, we're putting in the right renovations, and for some reason, if the market stalls out, we're gonna be able to keep this thing and still cash flow it. All right, guys, so we are at our bulletproof flip out in Edmonds, Washington. So why is this thing bulletproof against any kind of economic downturn? Well, the first reason it is because we bought it right. We paid $325,000 for it. That was well below market value, but the reason we got such a good price is it needed a ton of repairs. We're putting $100,000 into the renovation, which is rebuilding this house from the inside out. That gives us a total cost basis of $425,000 on the project. It is worth $600,000 according to the comp that's only 3 doors down. Right now, we are anticipating after all of our leverage costs, our purchase price, our renovation, and our sell cost, that we are gonna net out around $90,000 on the flip. So why is this a bulletproof investment? So if the peak pricing of $600,000 comes down 10%, we still have $35,000 in room for our profit. In addition to, this deal works in all different ways. Let's say the market drops 20% and now we're gonna break even or lose a little bit of money. We are able to refinance this property under the BRRRR method and refinance it all the way up to the capital that we have in. Remember, our loan to value right now is at 70% loan to value. The banks will actually lend us up to 75%. So the mortgage cost, if we refinance all of our cash back out at 71%, is going to be right around $2,600 a month. Market rents in the area are at $2,800 to $2,900 a month. So even if the flip goes sideways and we can't sell it in rack of return, we can keep this property, which is fully renovated, that we're not going to need to put any more additional into the building, and still cash flow over $300 a month. Then once the market starts rebounding and rates settle down, then we can sell it later and actually get a short-term capital gain rather than a long-term capital gain. So as we go into this transition market, as an investor, you can protect yourself. Look at a deal with multiple different exit strategies. If you're buying more expensive properties and you're concerned about the market, either pad that extra walk-in margin or go into a little bit more affordable projects like this, to where if everything goes awry, you can still rent it and keep it without it being a liability. A lot of people are gonna say, well, how do you buy them that cheap when the market's this hot? Remember, as rates start to go up, inventory will start to increase. That is gonna give you more opportunities in the market. In addition to, as the market starts to cool down, so does investors' appetite. That old Warren Buffett quote of be fearful when other people are being greedy, or be greedy when other people are being fearful, is coming into play right now. As investors exit the market, it's gonna bring more opportunities. Look for the cheaper opportunities that fit your buy box. Make sure that you can get qualified for a conventional loan, and then have multiple exit strategies on each deal. Either way, I'm gonna be happy with this property, whether I get to keep it in cash flow, $200 to $300 a month, or sell it and rack a $90,000 profit. I hope you enjoyed this video on how to become a bulletproof investor for the remainder of 2022. If you did, like and subscribe below, or check us out on Project RE on YouTube or J Dane Flips on Instagram, and we'll see you guys soon.